Hey everyone, me Kevin here. In this video, we're going to go through Federal Reserve expectations from both TS Lombard and Deutsche Bank. We're going to evaluate, will the Federal Reserve go for 25 or will they go 50 based on some of the latest data that they received, and are there any red flags that are actually concerning the Federal Reserve? And unfortunately, the answer to this is yes, there are some red flags. So let's go ahead and start with Deutsche Bank's take, and then we'll get into, which is a little bit more of sort of a bullish take. We'll get a bullish take from one portion of TS Lombard, and then we're going to get a little bit more of the bear scenario. So we're going to try to keep it as balanced as possible. So with that said, let's get started with Deutsche Bank. All right, here we go. Deutsche Bank. Deutsche Bank says that the household survey of employment that we got this week was actually more upbeat than what we've previously had, which is good. So the household survey is, remember, different from the payroll survey, and the payroll survey wasn't that great, but household was okay. 168,000 up from July, and the unemployment level down 48,000, which helped bring that unemployment rate down to 4.2%. Now, obviously, we expect that there'll be some large revisions here, but Deutsche Bank right here thinks this data was not weak enough to justify a 50 basis point cut. Now, I personally think, based on what we've seen from Jerome Powell and based on what we've seen from, well, frankly, the collection of ISM data or jobs data or other recessionary signals, I think the Fed is really at risk here of going way too far, and they should act a little bit more quicker. But my opinion notwithstanding, it's important to take a look at some of what they say here. They argue that both the New York Fed President, Mr. Williams, and Fed Governor Waller gave outlook speeches on Friday after that payrolls data came out. And they said, while payrolls data was somewhat disappointing and the labor market does continue to cool, Fed speak from these two particular individuals over at the Fed indicated that the softening we saw in the payrolls report was not enough to motivate a 50 basis point cut. In turn, we continue to expect the Fed to cut by 25 basis points September 18th. Mind you, that's not this week, but the week after that. This week, we are going to get CPI and PPI data, and there are some risks in that data that we're going to talk about, and we'll talk about that in just a moment. Deutsche Bank continues to believe we're going to go 25 BP September, 25 November, December. That would actually mean we would have to do some unpricing of Fed cuts, and that could be painful for the market in the near term. Right now, and this is interesting because it's been such a volatile movement, but on Friday, we actually saw Friday AM when the data hit, or I should say right before the data hit, we were right around 1.35 cuts priced in for September. This was right around when the data hit. As the data was getting digested, so data digested, we were at about 1.65 cuts priced in, which basically means you have a 65% chance of a 50 basis point cut. And then after all that was said and done, after Waller and Williams talked, so we're going to say post Williams and Waller, we actually went back to where we sit now, 1.325, which means we're only at a 32.5% chance of getting that 50 basis point cut September 18th. That, by the way, this is why yields started rising again. At one point, the 10-year, for example, the 10-year was down as much as 7 basis points on Friday, and it actually ended the day at just down 1.7 basis points. So a lot of that has to do with the Fed speak, and that's specifically Williams and Waller pouring a little bit of cold water on this idea that this jobs report is so bad that we have to mega cut quickly. Besides, there are still some risks for inflation. Both of them argue that inflation is not quite done yet, and since they're going to issue a new summary of economic projections, what they could do is they could go 25 plus they could add in dovish expectations into the SEP. So, you know, like, what would you rather have? Would you rather have a 50 basis point cut and a little bit more hawkishness on the projections? Or do you go 25 and go dovish on the S&P? Does it really make a difference? Who knows? But here is a concern that Deutsche Bank sees for markets. Given the surprise spike back up in rental inflation in the last CPI report, much of the focus now will be on whether or not July was an anomaly. In fact, there are several regions that saw rents accelerate in July, with the most striking increase in rents in the West. This is unsurprising to us over at HouseHack as well, because again, the West has been notoriously underbuilt, and this continues to be one of the big motivating factors for why I'm such a bull on West Coast real estate at the moment. Liberal states are just really bad at building more real estate, whereas more conservative-leaning states give you some more freedom to build much more quickly, and therefore you get a lot more building, lower rents, lower prices, potentially with more supply, and constrained supply in some of those western regions, particularly in larger cities. Again, also where you get constraints of supply. The problem with that is, what we don't want to see is shelter inflation start moving up consistently, because shelter inflation, as you know, makes up about 34% of CPI, makes up about 25% of PCE. And if we start seeing those numbers move up too rapidly, we could quickly be in a position where the Federal Reserve actually slows down its pace of rate cuts and then just pushes us closer and closer into an unemployment recession. Now, it's not what I believe is highly likely, mostly because I believe we're going to see significant deflation in services ex housing and goods pricing. I don't really think companies have as much pricing power as they've had in the past. Small PP, little PP. We know this. We expect this. We study earnings calls every single day. And there's so much competitiveness right now for pricing and to try to get those customers. The pricing's just coming down. This is actually one of the things that we think we're doing, and we realize, as we're getting started, we're going to be a little bit more attractive to larger account sizes, but that's what we're trying to do over at StockHack. We're launching our financial advisory service on October 1st, and we're bringing the basis points for AUM down from what you usually see around 1% down to 0.69, and then we're doing a monthly flat fee rather than what you usually see, which is like an hourly sort of retainer with an attorney, like almost like an attorney, right? And that's no shade on attorneys or the way the financial industry works. It's just that's our opinion of how we could be more competitive while starting to service larger accounts first. Of course, we'll be open to anybody. And learn more about that at stockhack.com. But it's just an example where as new businesses come in, you tend to see more competitive offerings from new businesses broadly, and or different pricing models, and that can generally bring an industry's pricing into a lower direction, especially for financial consulting on real estate or whatever. And I mean, combine this with financial advice or just white collar businesses in general are suffering a lot of layoffs right now, mostly, mostly in my opinion, because I think a lot of companies were probably just maximizing their use of AI to every extent that they can to try to aid more clients. In other words, put more workload on some people using AI and basically have less employees in aggregate. Now, again, that's somewhat unfortunate for employees because it reiterates my thesis that in the long term, we're probably going to have more of a deflationary future where labor pricing actually comes down as well, because people are like, look, I used to make $200K a year. I'll work for $150K. Just please give me a job. Real risks here. Anyway, other categories of note will be used vehicles as well as airfares and little other details. Of course, we'll be looking at those as well. But it's interesting because seeing Waller and them emphasize that, hey, this employment data maybe isn't that bad and we still have work to do on inflation, even though they could be part of a more hawkish side at the Fed, it does show that it's not all going to go dovish in that meeting with J-Pow, even if J-Pow is on the dovish side. Now, another thing that's interesting here is Waller emphasized that if subsequent data showed a significant deterioration in the labor market, the FOMC can act quickly. And I wrote this little note here that basically said, Basically, go 25 and freak out if we need to. Yeah, exactly. So in other words, like, hey, we could always flick the switch and cut rapidly if we need to. Sure, but then you're probably going to be too late. That's at least usually how it works out. Okay, so now let's look at the TS Lombard bear piece, and then we'll look at the more neutral kind of bullish piece. Take a look at this. August employment data will keep the Fed at 25, so they actually agree with what we saw over at Deutsche Bank. And they say, yes, August was an uptick from June and July, but given the combined 86,000 downward revision to those months, does anyone believe this month's data will hold up? This is sort of, I mean, rightfully so, jading a little bit the data coming out of the Bureau of Labor Statistics and saying, look, like it always comes in high to start with, and then it comes in lower later. So then they ask whether inflection, whether this jobs inflection, turns into a recession or something less negative. Oh, and I like how they define recession. 3 months of declining private payrolls, that would be negative payrolls. Not there yet. Or something less negative depends on how aggressive the Federal Reserve counters the current negative momentum. And I think that's interesting. You're basically saying, hey, look, we've got negative momentum right now. Is the Federal Reserve going to act quick enough to stop us from starting a recession? Because once we get started in a recession, you create this self-fulfilling consumer doom loop of a lack of spending and pain. Now, TS Lombard says that their own sort of version of understanding the yield curve puts a recession start at Q4. Folks, we're in the second month of Q3. I'm sorry, we're in the third month already of the third quarter. Q4 is just now 3 weeks away. This is crazy. This suggests that TS Lombard suggests the Federal Reserve could be making a mistake and pushing us into recession in as soon as 3 weeks. Yikes. Take a look at some of the factors that they give for this. One might think that 50 is reasonable given Powell's comments at Jackson Hole. We do not seek or want further cooling in the labor market. And the Beige Book backs this concern up, with flat or declining activity rising from 5 to 9 of the districts, all of them suggesting that firms were only filling necessary positions, that they were reducing hours and shifts, and there was a lower overall employment due to attrition. This is all bad. Now, obviously, there's some ongoing consumer resilience, which is great, but the question is, how much liquidity is there in markets to actually keep us out of recession? TS Lombard thinks as soon as possible, we should be cutting by 50 basis points. So let's take a look at some other items here. They say that right now, the forward Fed funds pricing is not pricing in a recession. This is basically a way of saying the market's not pricing in a recession at this point, and that if they do, yields could fall even lower. And we'll look more in just a moment at this piece from TS Lombard, which goes through some things that are good and some things that are bad. But I thought this was really interesting because it shows you the ISM manufacturing survey and how it's still sending you these bearish signals because you've just been negative really over here all of 23 and 24. And really the only thing that's been holding it up, frankly, has been artificial intelligence. And I don't know how long that flame can keep burning. But anyway, take a look at this. Markets are pricing in a run of good fortune. Markets are basically pricing in that we're going to get Fed cuts, the economy will keep growing, and inflation is stable at 2% by mid-2025. Now, this may be the easiest bet, which would basically be like go long NASDAQ and call it a day, but it is the most unlikely combination to occur. A recession or a bounce with more inflation is the more likely outcome, and they argue it all depends on the Fed. So if the Fed mismanages the landing, we're going to get either a recession or a big second wave of inflation. It wasn't great. They do argue that the August data that we've gotten is not recessionary by itself, but the anecdotal evidence, which can sometimes be a little bit more of a leading indicator, is a, quote, precursor to recession. The Fed has learned to take anecdotal evidence seriously around inflection points, and here we are. However, caution will rule at the Fed, as it usually does, and they'll probably cut 25 and just wait and see. T.S. Lombard's writer here says, I believe that would be a mistake. Now, keep in mind, there are still some good things over here. So take a look at this. Even though ISM manufacturing has been below 30, indicating under 50, indicating contraction for a while, services remain above 50, but at levels that are well below non-recessionary averages. One way you could see that a little bit more clearly is just sort of draw a line of where we sit right there. And you can see how low we are on ISM services. That's this chart right here on the left. Hard data does point a rosier picture, so durable good orders, factory orders. I still think a lot of that is because of AI, and so again, I question how that'll go. They reference the SOM rule, which did tick up again a little bit. They do say that the solid U.S. jobs market strongly suggests that higher unemployment and lower consumption spiral that typically leads to a recession has not started yet. That's true. I agree with that. I don't think the real recessionary doom loop has started yet, which actually implies something good. This implies the Fed still has time to save the day. So, you know, if I had to guess where we sit in terms of like how close are we to recession, I kind of agree with the last T.S. Lombard piece that if the Fed moves too slowly here, we could be, you know, within a few months. I think by Q1 we're probably knee deep in a recession, but you know, that's just my opinion. They do also argue here that construction jobs are collapsing, which is not a great sign. They did wonder if that had to do with interest rates. So what I wondered, though, is maybe this drop right here was the interest rate drop, and then the drop that we're getting on the right over here, that might be a little bit more indicative of a recessionary decline there. Construction job openings have collapsed in recent months, boding ill for employment. The risk is that given the cyclical nature of the sector, this is a precursor to a weakening trend in the broader jobs market. Again, this is a very interest rate sensitive industry, though. You know, what I'm going to do, just because, well, I mean, I'm just sort of thinking about it now. Why don't we look at this? Let's look at construction job openings, and let's go look at the St. Louis Fred. Let's see if we can get a chart. Yeah, we can. Job openings, construction. So we can get a chart on this. It goes back to 2000 basically, so 2000. Okay, all right. So let's take a look at this chart just to see individually how useful that is. I mean, construction jobs definitely decline in a recession. You did have a decline from peak over here in 2007. Boy, I just hate seeing the comparisons to 2007. You had a decline in 2001, but you also had a decline over here in 2016, and you had a decline over here in 2019. Now, nowhere near this magnitude. I mean, look how far we've gone back. We went from July 2024, we're at the lowest level of construction job openings since basically November of 2020. Wow. Wow. These are just about January of 2018 levels. But, I mean, this is in line with the peak of what we saw in 2016. It's also somewhat in line with the peak of what we saw in January of 07. So I guess I'm not entirely certain how useful that one indicator is on its own. But I do think when you have these sudden plummets like this, it's worth paying attention. It's certainly really, you started seeing a decline there in June and July. And that's also when we started seeing some more pain at some of the, how would you say it, the earnings that we've seen. Now, earnings broadly have been good, like EPS and everything, but in terms of some of the guide that we've seen, not as fun. So earnings surprises in the U.S. have been, you know, pretty negative, but they were negative in 22, they were negative in 23, so I don't know how useful that is. GDP forecasts are, you know, for 2025 showing that we'll be somewhere around 1.7% absent a recession. All right, I mean, that's not necessarily bearish. Investor positioning has changed substantially in the past 2 months. In equities, investors have reduced their S&P 500 positioning to about neutral, while increasing their NASDAQ exposure substantially. In rates, they have gone longer the 30-year, while going very short the 10-year. And in metals, they have gone long gold while reducing copper. So basically, more NASDAQ, but also buying more 30-year and more gold. Now, I'm a big fan of the 30-year, and I'm a big fan of some exposure to gold right now. I'm not the biggest fan of exposure to risk assets going into a recession. So, unfortunately, no, I'm not the biggest fan of the NASDAQ-a-doozles, and I'm also not the biggest fan of Bitcoin right now. I think it's too much of a risk asset at the moment. And it just won't fare well in a low volatility time. High volatility, low liquidity time. Equities are lagging REITs since early July. In other words, equities are underperforming real estate investment trusts. That's kind of wild. And then right here, current expectations are somewhat at odds with past soft landings. I thought this was an interesting argument here. This basically shows a chart where they say that if we were pricing the bond market for a recession, we should be pricing in over here in this lighter green line. We're actually kind of pricing in between the no recession and the recession line. So in other words, there's still a lot of downward pricing to put in there, should we be going into recession. So how do we reconcile this? Well, we've got a few different things here. Number one, we've got T.S. Lombard on the bear side that says, look, if the Fed gives us 25, we could have a recession as soon as Q4, and the Fed's just going to have to cut really, really rapidly. That's going to be fan-frickin-tastic, by the way, for, in my opinion, mortgage companies. I think they're going to frickin' skyrocket because people are going to want to break the piggy bank of the equity in their homes. And that'll be great for mortgage companies. Also, anybody who financed at 7 or 8%, 7.75, they're going to want to refinance after, the first year that they've had their loan. So probably pretty good for mortgage companies. I would expect that interest rate sensitives like an Enphase and a Tesla should do well as well in the face of emergency cuts, but not in the face of a white-collar jobless recession. So I've become much more bearish on that future. I think that will come later in the cycle. Like, I think the interest rate sensitives will be much bigger beneficiaries if we get from that 2% level to 0 rather than from 5 to 2. So anyway, I guess we'll see. So you've got that bearish piece that says we're 3 weeks away, basically, which I guess it could be anywhere within the fourth quarter. So 3 to 16 weeks would be a full quarter in there. I got something in my eye. That's really annoying. Then what else? Some other updates. Oh, I wanted to, okay, well, yeah, and then, of course, you do have some bearish there, some bullish things. Deutsche Bank thinks 25, says it's not that bad. We had more labor force participation. That's why the unemployment rate went up. Maybe this time is different. And then forecasts for earnings are still pretty decent, as long as, obviously, AI keeps up. But I wanted to just throw a little note out there. If anybody's ever been to Halloween Horror Nights, I have to say I was thoroughly disappointed with Halloween Horror Nights. And I've gone many times before in my, sort of lifetime. I actually really have always enjoyed Halloween Horror Nights, so I feel kind of miserable saying anything bad about it because I would generally encourage people to go. But I have to say, I can't anymore. This is the first year that I've gone where I've just decided I will not promote Halloween Horror Nights. It's not sponsored or anything either, just sort of free PSA, so to speak, public service announcement. But Halloween Horror Nights used to be really cool because the rooms you'd go into, they were so dark. You'd kind of have to walk through like this, and you're like, oh man, and people would jump out at you from corners and behind you and from the side, and it was actually scary. You didn't know what dark corner was gonna spook you from. Now the rooms have become, probably because of liability lawsuits, I don't know, maybe California, I don't know. The rooms have become very well lit. The scarer people generally are about 4 to 5 feet away. The scare is almost always in front of you, and it's pretty freaking predictable where the scare is coming from. So we did the RIP tour, which is basically the, it's not that much more money, but it's like a VIP version, and I was pretty disappointed. It, even though you skip the lines, I'm still like, oh my gosh, I don't know that this was worth my time. Now, I really enjoyed the company that I was with. I generally always do. But the actual experience itself was somewhat disappointing. So I don't know that I'd be willing to go again. I think I'd be more interested in going to Islands of Adventure and just going on all the rides in Florida. So anyway, a little bit of extra life story from me, so to speak. All right, anyway, thank you so much for watching. I wish you all the best. Good luck out there. And remember, go to stockhack.com. Even if you don't want to custody your assets, that's okay with us and what's likely to be JPM. Know that you could sign up for consulting with my team, which is basically with me via them. And we think it's going to be a great service. So you go to stockhack.com, launches October 1st. We'll have a lot more paperwork likely coming out soon. But we'll have business entity advice, tax strategies, business consulting, retirement plans, plans for your children, property management advice, construction and renovation advice, real estate acquisitions, dispositions. That's huge, by the way. Not a lot of people give sort of like real estate consulting. And so we think that's a really, really good product, especially since it's just a flat monthly fee and joint fee if you don't have any assets there. So go sign up on the waitlist over there at stockhack.com to learn more. And hey, as always, thank you so much for being here. We'll see you in the next one. All right, goodbye and good luck.
These things that you told us here, I feel like nobody else knows about this.
We'll try a little advertising and see how it goes.
Congratulations, man. You have done so much. People love you. People look up to you.
Kevin Paffrath there, financial analyst and YouTuber. Meet Kevin. Always great to get your take.
Even though I'm a licensed financial advisor, licensed real estate broker, and becoming a stockbroker, this video is not personalized advice for you. It is not tax, legal, or otherwise personalized advice tailored to you. This video provides generalized perspective, information, and commentary. Any third-party content I show shall not be deemed endorsed by me. This video is not and shall never be deemed reasonably sufficient information for the purposes of evaluating a security or investment decision. Any links or promoted products are either paid affiliations or products or services we may benefit from. I also personally operate an actively managed ETF. I may personally hold or otherwise hold long or short positions in various securities, potentially including those mentioned in this video. However, I have no relationship to any issuer other than HouseHack, nor am I presently acting as a market maker. Make sure if you're considering investing in HouseHack to always read the PPM at househack.com.